We take a closer look at the issues facing the banking sector. I spoke to Mark Levine earlier at Pacifica Radio Host and asked him about the financial losses at Barclays, JP Morgan, and also the IPO mess from Morgan Stanley, and if that meant more regulation is coming.
I would argue this proves we don't have significant banking regulations in all three examples that you gave. Clearly it's true in JP Morgan. I think JP Morgan is, if you were, well, the tremor prior to an earthquake. This is the warning sign. If we don't act after JP Morgan, then when the earthquake comes, we kind of deserve the consequences.
To be fair, Jamie Dimon went up and testified in front of Congress, and he had a lot of questions peppered at him. But what regulatory rule would have prevented this from occurring?
I actually think the proper implementation of the DoddFrank bill by the SEC, as you know, they're drafting the regulations now. When the London whale, when Bruno Ixel went and made his $2 billion or $6 billion error, we still don't know how large it's going to be. At that time, Jamie Dimon was up on the Hill arguing that the regulations were too harsh on banks. It turns out they weren't harsh enough. The whole purpose of the Volcker Rule, which is in the Dodd-Frank bill, is to say that banks shouldn't be able to take risks that basically risk the whole banking system.
But to be fair, look, banks take risks every single day. They make loans to small business owners. They make loans to restaurants and dry cleaners and to people who buy houses. Aren't those very big risks?
Nobody complains about those. Those are ordinary banking risks. Those are the kinds of things that were allowed under Glass-Steagall. That's the banking business. Where people have problems when banks go into the gambling business or the hedge business or the credit derivative swap business, when they're gambling on instruments that they really don't fully understand and risking huge amounts of money. I mean, this was a $2 billion loss on a tiny change in interest rates between the United States dollar and the euro. This is something that banks should not be allowed to do because, let's face it, it could easily be 20 or 200 billion and not just 2 billion.
Let's talk about the other current news, which is Barclays. This almost looks to be somewhat of a conspiracy, if you will, that's been accused by some of the banks as to fixing rates regarding LIBOR, which for our viewers is the short-term interest rates that banks charge each other. Why is this such a big deal, and why should people care?
Well, they should care for the same reasons we have antitrust laws. You shouldn't be able to have firms conspire to fix prices.
Do you think it's true?
I don't know whether it's true. I don't know the people at Barclays, but we should definitely have regulation to explore it and to stop these kinds of things before they happen. One of the things we've learned about the Great Depression that we're in is that a lot of times we can't know the consequences of small events until after they happen. No one would have predicted the failure of Bear Stearns or Lehman Brothers, and even more so the great worldwide recession that occurred afterwards. We need to stop these things when they're small tremors and not try to fix them after they're earthquakes.
Why is it that government has to seemingly take this role of preventing or stopping these debacles from taking place, rather than saying, why can't the CEOs, the board of directors, the executive board take more leadership and more accountability? Now, I know you're laughing, but you know where I'm going with this, is how much is too much?
That's like saying, why do we need police officers on the street? I'm sure good people won't murder other people. Well, it's certainly true the vast majority of good people don't murder other people, but you need police officers there to stop the bad guys.
But how much is too much?
It's too much when it stops ordinary business. But the whole purpose of regulation is not to stifle business. It's to prevent business from going off the rails.